I'm excited to have Paul Hodges on the show. Paul's the chairman of Normal Consulting. He's a trusted expert and provides guidance to the World Economic Forum. Paul, in my opinion, is a bona fide, true financial expert, understands how demographics influence the markets over the long run. And I think he's got a lot to share, a lot of valuable things to share with us. So, Paul, welcome on our show. I'm happy to have you.
Oh, great to be in Michigan.
That's right, and all over the place. Hopefully, when this gets out.
Yeah.
So, Paul, I'm really interested in picking your brain on a number of fronts, and it's from the standpoint of being in Michigan and in the United States. What I really appreciate is you're not in the United States, and we get consumed with ourselves here in the U.S., as you know. So it's nice to have a third-party perspective that can help us see ourselves through a different lens, if that makes sense. So with that, one of the things I want to start with is just your assessment of the global equity markets right now. Specifically, what I'm curious about, are we in what amounts to sort of an up-only cycle for certain assets due to the enormous amounts of global debt and the obligations, particularly here in the United States?
Well, that's a big question. So how long have you got, really, Terry? Just to add for the benefit of the audience, I have actually lived and worked in the States, although some people might not say it was the States because it was in Texas, Houston, Texas. And I have a son who was born in Houston, so he is a genuine good old boy. So I'm not just an outsider. I'm a sort of insider outsider type person. The honest answer, I think, to your question, Terry, really goes back to 2000. And if viewers remember the dot-com crisis, we had an enormous bubble in dot-com where it didn't matter whether you made profits or not. It was all about eyeballs on the screen. Mm-hmm. And then there was a fantastic crash, and the NASDAQ went down 80% within a couple of years. And the response of the Fed under Greenspan and the response of the central banks was quite different to their response to any previous crisis. So that in the past, their job had been to take the punch bowl away as the party starts going. This time round, Greenspan came forward and said, look, we've got to make sure the market is going up, and because if the market goes up, then there's a trickle-down effect, and that boosts the overall economy. Whereas the market is down, then we all lose out. Which, to be fair, sounded as though it made some sense. However, when you looked into it in more detail, what you saw was that there was a conflict emerging between the traditional driver of economics, Friedman, and monetary theory, and the real world in which we live. So you mentioned demographics, Terry. What essentially we've argued for quite some time now is that there was this key development after the Second World War called the baby boom. And in the States, in the 18 years after the war, from 46 to 64, the number of babies being born was 52% higher than in the previous 18 years. It was a record level. And so if you think about the 50s and the 60s and the 70s, what you had was, first of all, a manufacturing society and an economy badly disrupted by the war. In the States, we weren't as badly disrupted as obviously in Europe, where things have been bombed to bits, literally, and where buildings were now car parks and so on. But the whole economy had been devoted to manufacturing tanks and planes. It hadn't been devoted to manufacturing consumer goods for 5 or 6 years. So there was already going to be a supply-demand imbalance, and suddenly you went from 2.5 billion people in the world to around 4.6 billion. So nearly doubling. Mm-hmm. And now Friedman came along at that time, and to be fair to Friedman and his theory, the data wasn't around. He didn't know what the population had been, what birth rates had been pre-war. It just wasn't published. When we first published our book, I can tell you, it was an enormous difficulty. We had to sort of call up national authorities and talk to people. He said, that's a really interesting question. I'm sure we must have some data somewhere. Uh, and you can imagine in the States, if you're in Kentucky and your wife has a baby in the middle of harvest, are you going to stop the harvest and ride into town to tell the sheriff? Nah, the baby's probably going to die
Probably not.
anyway. As they did in the 30s quite easily, unfortunately. So the records were very difficult to get. So Friedman fastened on this idea of monetary policy and that it was all the Fed's fault. They shouldn't have let monetary policy out of control, and then there wouldn't have been inflation. And Greenspan inherited that view. But he took it the other way around. So he said, well, if we boost monetary policy, we can then get inflation. Familiar story. We've heard it from Greenspan, we heard it from Bernanke, we heard it from Janet Yellen, and we heard it from Jay Powell. Only problem is, until very recently, it didn't work. So lovely theory, shame about the practice. And I'll sort of stop there, but just leave you with the thought that what essentially the central banks have been trying to do for the last 10, 15 years is to print babies. Because the problem you've got is twofold. And I call it a problem in inverted commas. One problem is that since 1970, women have not been having enough babies to replace the population. So you have to have 2.1 babies per woman to replace the population. We haven't had that in the States. We haven't had that in Europe. We haven't had that in Japan, and until various other countries. So we've not been replacing the population. But what we've also had is that life expectancy has been increasing, so that instead of in the 1950s you retired at 65 and you died at 66, now you actually live till you're 80. But if you look at all the data, we call them the perennials, the people over the age of 55. And the data from the Bureau of Labour Studies and everything else shows you that spending peaks in the 25 to 54 age group, because people are going into jobs, they're building their careers, they're settling down, they may be having babies. Anyone's had babies knows it's blooming expensive. And
They are.
and so on. But after the age of 55, you're not having many babies, and you already own most of what you need, and you're moving into retirement, so you have less money to spend. So the perennials, like myself, absolutely lovely generation. I don't want to get rid of them at all. Please don't get me wrong there. But we're no good for the economy. And what the Fed has therefore been trying to do with its monetary policy is to print babies. And that's why you've ended up with a large amount of debt, because you can't print babies. The whole thing is impossible.
No, I understand that. And I guess the one fortunate piece for the United States is that we had what you'd call the echo baby boom, which is the millennial generation, not as big as the original baby boomers, but that's something that Europe, China, Japan didn't have. Did I get that right?
Well, you see, people have asked me that question. We've gone into this in some detail. And I'm afraid, I don't want to get into the race question per se, but just to use the official Bureau of Labour Studies definitions, what you have to look at is, with the white population, which is around 2/3 of the US population, what you see is a profile which is very similar to Europe or Japan.
Okay.
So, in other words, you sort of median age of the white population is somewhere around 45 years, and incomes are around $55,000. The younger population is the Black and Hispanic population. And so they're the other third. There's some Asians who are more or less the same as the whites. But the problem with the Black and Hispanic population is, yes, it's definitely younger. It's down sort of around median age of 30. So that's where you think, oh, yes, this is going very well. But it only earns around 2/3 of what the white population does, for various reasons we don't need to go into. And so when you say, oh, don't worry, we've got all these young people. Yeah, but it's a bit like saying, and I don't want to push the comparison too far, oh, it's all right, India's still growing, so the world economy is okay. Well, if actually it's relatively poor people who are the growing population, they don't add a lot to the economy.
Right.
And
Right.
so you're balancing, people like myself, we're a growing number of people every year, coming into this perennials thing, against, yes, a reasonable number of younger people, but their earning power and their spending power is much less.
And maybe that's why you're seeing some of the political messaging now and trying to change that to some degree, because that's a
Yeah,
way that we might be able to long term solve part of
exactly.
the problem.
Yeah,
And when we talk about that, I guess one of the things that concerns me at this point is, if you look at, this is not my expertise and my background, but I've done enough reading that I think I understand it reasonably well.
mm,
When you look at the tax revenues that we have today particularly in the United States, um, that by the time that you add in the interest on the debt, entitlement obligations that we have, defense spending, and if I just stop right there,
yeah.
the tax revenues don't even cover that,
No, no.
as I understand it. So it seems to me that some pretty smart people that I follow have suggested that for the United States, in the short term, we might try to raise interest rates and to create some fiscal responsibility, which is not likely to happen. That'll run its course for some inept short period of time, and then we're back to printing our way out of the problem, which is paying all this debt back in radically discounted dollars, which means that cash, treasuries, bonds, those don't go anywhere, but equity assets like stocks, real estate, commodities, maybe cryptocurrencies, those are likely to get inflated quite a bit. And that's how we sort of solve this problem. And it could take 5, maybe 10 years. But once we get through that cycle, we might be in a better position. Do you see it that way, or do you see it completely differently?
I understand the argument perfectly, and I wouldn't say I disagree with it. But what I'd say is I think there is another dimension to it, which is that uh, where we've been is a world which believed that a rising stock market was an indicator of economic success and personal
Mm-hmm.
success. And what I think is happening is that, and I'm not saying that people have stumbled on the demographic issue, finally. Although I think more people are talking to us about it than they used to 10 years ago. Um, what I see happening is more of a political focus coming back into this. And so, when I was growing up, you had congressmen uh, on both sides of the House, and you had MPs in the UK and so on, who had practical experience of life. It might have been in the unions, it might have been in management, it might have been in the law, it might have been doctors or whatever. And they brought that to their discussions about laws and the economy. And they thought, tackling the economy was the most important thing.
Mm-hmm.
But then when we got into the post 1983 period, where suddenly all of these baby boomers moved into what we call the wealth creator age, so 25 to 54, and so on, basically the economy went on autopilot. People say, "Oh, it was Paul Volcker." I thought Paul Volcker was a fantastic man. I really did, but I don't actually think he had much to do with slaying inflation. I think what happened was that we had suddenly, from lots and lots of demand, we began to get more of an equilibrium in terms of supply and demand. So not only was there constant demand, but also people like myself were going out to work. When I was living in Houston in those days, we're full of people of the sort of 30s and 40s, all making our way in the world. So there
Mm-hmm.
was a lot of supply coming in there. In fact, and there was a lot of demand, but because there was so much demand, we were able to outsource that first of all to Eastern Europe. The Iron Curtain fell, and then to China, and so on. So on. But where we are now, I think, is that we're going to go back to government taking responsibility again for the economy. And what do I mean by that? I mean fiscal policy is now going to become important, and there are going to be great debates about it, as there should be. Where should fiscal policy apply? Should it apply to people of a certain age? Should it apply to people of a certain uh, industry group? Should it apply to a region? Who are you trying to help here, and whose money are you spending to help them?
Mm-hmm.
These are critical political questions, and so Joe Manchin is quite an interesting actor, I think, in all this as the swing voter in the Senate. if you like, for the Democrats, and he's reflecting the average person's concern about
Hmm.
inflation. And so we're seeing Jay Powell, who couldn't care less about inflation 6 months ago. Oh
Right.
yes, it's transitory. Well, have you looked at what's actually happening? And I mean, Terry, our report for most of this year has been going on about supply chain problems
Hmm.
and inflation. We couldn't stop going on about it. People could say, "Oh, you're wrong. There's no sign." You're going to see it, guys. You really are going to see it. And here we are. Everybody's now going on about inflation. Joe Manchin's going on about it. So that shift, um, and what's quite interesting about the concern of inflation, which is different from before, is that people are very worried because they see all these help wanted signs.
Hmm.
Now, when I first heard this, I found this quite difficult to understand because, if you like, I grew up in an era where help wanted was what you wanted. I needed, when I was a student, I needed a back job. When I came out, I needed a graduate job and so on. I wanted people to want to employ me. And so I'm
It's a
starting to
different
worry.
attitude now.
It clearly, people have got the idea that something is wrong in the economy, and they can't understand clearly what it is, and clearly what's coming across to them from the Fed doesn't make a lot of sense. So they're worried. And you see this in consumer, the University of Michigan consumer expectations.
Hmm.
Is this a good time to buy a house? Is this a good time to buy a car?
Hmm.
No, prices are ridiculously high. I'm never going to be able to afford it. It's a very bad time indeed.
On that note, Paul, so that strikes me there's a few things at play here. Okay. One
Mm,
is that we've gone from a media that we've gotten to an activist media now, right? They're no longer just presenting the news. It's
yeah.
news with opinion, and they're actually either part of the
Mm,
story or shaping the story, right? So you've got that doesn't help.
no.
Um, my view on the labor issue is a couple of things. I mean, obviously, with your background in demographics, the baby boomers have in the United States and Europe in particular, but also China and Japan.
Mm,
The baby boomers have left and are leaving the workforce, never to come back. Okay,
yeah.
so we had that structural issue to begin with.
Mm,
But what COVID has done, and this is just my
mm,
observation, is that we've highlighted a high level, and I say high level. I don't know what the percentages are, Paul, but my estimation is that there's a group of people in the United States that are in other parts of the world that are prone to health anxiety, and so these people have been scared shitless
yeah.
by the media, the politicians, and so
Mm,
forth, and they're not going to go running back to the workforce because
mm,
they're afraid that if they don't social distance, if they don't wear a mask, if they don't get a vaccine, if they don't get a booster, they could die.
yeah.
And so we've got able-bodied people that could go back into the workforce that haven't yet and might not. And
Yeah.
then on top of that, what I'm concerned about in the United States is that for the longest time, it's been more than a year now, and it ended in September. We were paying people at the lower end of the socioeconomic scale as much as $40,000 a year tax
Mm,
free to stay home and live their lives.
yeah.
And so when you go from that to going back to work for half that and paying taxes on it, doing a shit job that you don't want, you don't like, right? That's not a really appealing proposition.
Mm,
And those people are still having to sort that out because they may have a few bucks set aside where they can kind of kick the can down the road a little bit. But as we get into 2022, I don't see the labor issues resolving all that easily. And that's going to continue on top of all the other supply chain issues, which we know are structural, from hollowing out our manufacturing and sending it overseas. That's not a short term fix. So I don't really see this as being a short term problem. And I think this lingers in 2022. The issue that I have is you can have all that and still have a stock market that goes up. And maybe I'm wrong.
well, I was just gonna perfect intro, because I was going to say that I think that one of the odd things that's happened, and totally share what you just said there, described, Terry, is that you got a lot of people at home, and they were getting money for doing nothing, And you can argue about whether that was a good thing or a bad thing, but probably on balance it was a reasonably good thing, because otherwise they would have starved, or they would have spread the disease and more people would have died. So if we sort of say that wasn't a good thing, but who were they? There were a lot of young people, a lot of young men, and we remember the famous Barstool saga last year of the guy who switched from telling people how to do sports betting to how to do sports betting on the markets, and
Right.
and how people, brokers like Robin Hood and so on came along and said, "Oh, look, you can trade for free." Well, how do you trade for free? Well, we get paid for your trade.
Wasn't really free, as we found out, but
That's not my definition of free, but
right.
the offer. But if you look at the data, the retail investor has actually been critical in powering the later stages of this rally.
Mhm.
And it's been the meme stocks, because they go, I didn't know what a meme stock was. I'm a bit old and past it, but
My kids tell me that's the only reason I know.
exactly, yeah. And they're all on these Reddit chat rooms and so on. And you suddenly find them. They buy Hertz, and they buy AMC, and they buy all these meme stocks, and of course they buy the stocks they know, like the FANGs, and
Tesla.
then if you're a bit boring like me, you look into the detail of how is the market actually doing. And I'm sure you've done this with your clients, Terry, many times. So I won't rub it in detail. But essentially, the majority of the market has not gone up very much at all. But the overall market has gone up because of these absurd valuations in the meme and popular trend. So what I'm worried about then is actually the reverse of what you're saying, which is that the money has run out for those guys, and they're sitting there saying, "Well, I don't have to work because I can always make. I'm a genius. I make 1,000 a day trading on Robinhood. Why do I need to work?" Exactly. Are you still going to raise? I mean, I look at Kathy Wood's ARC fund as my indicator. There's always one fund that you look at and you think, this doesn't make any sense at all. And one day, everybody's going to realise it was a bubble stock. And she's gone up. I don't know what it was, 150 or something dollars. It's now down somewhere around 100, and I imagine it will go pretty close to zero over time. But all the people.
Well, let me ask you about that, Paul, because on one hand, I understand that these things got overvalued because of the retail push, right? And look, I think what I'm hearing you say is that you're worried that retail becomes liquidity for the institutions at some point, right?
Yeah.
So I get that. But on the other side for Kathy Wood, if I could just play devil's advocate for a second,
Sure.
you've got these exponential, and Raul, Paul talks about this all the
Oh,
time.
yeah.
Yeah, these exponential technologies. And so there is something to be said for exponential / network effect type things, the AI, the 3D printing, robotics, genome projects, things like that. So are you saying that those technologies at this point are just simply, or the stocks behind those are simply overvalued and they're not producing at a level enough to justify the prices, and eventually they have to come down? Is that what I think I'm hearing?
Well, I put my hand up, and I was involved in .com, and I was working out of San Francisco, Montgomery Street, with a .com company, which we raised $120 million in '99, and we were, had we gone public, we were told we would have a valuation of 24 billion. And that was March 2000. We only started to actually take in revenue in November.
You were 1 year too late. If you'd have just started
I
1 year earlier.
I mean, why am I sitting here wasting my time on this when I could have been?
I'm sorry. Didn't mean to rub that in.
Go. But no, we had Goldman Sachs as our underwriter. I mean, this is a magical world. And I was very, I understand your point, because I was then and am very committed to the idea that the internet was going to take over a whole range of things. I had no problem at all with that, and indeed it has. So the fundamental principle was absolutely right. But at the same time, Gartner, the sort of analysts, came out with what they called their hype cycle.
Hmm.
And what they basically argued was that a new idea comes on, and for one reason or another, it catches on with people. And this is a very, very important part of opening up the market, because people start to ask themselves, have you come across a mobile phone? Do you think a cell phone would be okay? Should I, and you remember that, the cell phones in the States had this peculiar habit that you had to pay to answer a call, which was, put a lot of people off, and nobody else had that, but the States did for quite some time. It was quite bizarre. And what I'm saying is, there can be good ideas, but people have got the radically wrong business model to make it work.
Right.
And so what? But it opened it up, and so what Gartner said, and they're still doing it, all sorts of it, is you go up like this, and you get to a peak of hype. There's very little performance there, but everybody knows this is the new next thing, and then people start saying, "Well, wait a minute, you're still saying that, and you haven't made any money."
Right.
I mean, you really haven't made it. You're not going to make any money. You go down here, and you go into the trough, and then the survivors come out.
Yep.
Because what they do is they very quickly go to business model 2.0 or 3.0,
Mm-hmm.
and they reassess. But you have to go through that first stage, because you're introducing. We used to talk about the chasm. How do you introduce e-business to people? I've got a sales force. I don't need internet. Yes, but if you didn't have a sales force, what you could do is everybody could come and order online. Well, why would they want to do that? I mean, in 2000, I used to do presentations to 1,000 people in hotels, because we were quite a sort of well-known organisation. And I would start, when I first started, I would ask people, how many people have bought a book online? And maybe 10 of the 1,000 have done it in early 2000. And then gradually through the year, most people have done that. So I then say, how many people have bought a flight or something more expensive? Oh, certainly not, So you have to have that hype in order to get people thinking about, well, I'm not going to do it, but I can see it might be a good idea for somebody else.
Yeah, it's
and that's where I think Kathy has got to.
Well, that's interesting, because that portends an 80% washout.
Oh yeah, absolutely. Oh yeah.
So so I guess we're going to have to digest that. I'm aware of Kathy Wood's fund. I understand the 5 or 6 technologies that she talks about. I personally haven't dug in because I don't own it, so I don't really care, relatively speaking. But I'd be curious when you start digging around and looking at the earnings. Forget about because Bitcoin is a separate issue, which we can talk about.
Yeah.
But the rest of the companies, I haven't dug in to see what kind of earnings they have. And so I guess you could make an argument that if it's what you've suggested, like it was back in the .com era, then there's going to have to be a big washout. And what's scary about that, obviously, is that that's what we just talked about, but that's retail becoming a liquidity for the institutional money, who is going to sit back, let it all wash out, and then pick the winners, right? The Amazon versus the MySpace, or the Google versus pets.com, that kind of stuff, right? That's where we're at, I think, is what I'm hearing you say.
Yeah, and you can sort of see it, in terms of another great stock, which also Kathy owns, of Tesla.
Mm-hmm.
I don't have a problem with Tesla. I think that they've recovered quite well. That they've gone through business model 1.0 to business model 2.0, and they're actually now building cars that people like to drive and that don't fall apart. I mean, Elon continues to do the wrong thing in terms of over-promising and underperforming. So he claims he's got autonomous vehicles, but he hasn't. I think, as far as I can see, he's got level 2 or something. But I think he's in the pack of the survivors. But the market is pricing him as though he is going to supply every electric vehicle in the world, and he's going to run every taxi fleet in the world, and he's going to run all the time. You go, guys, I talked to GM, I talked to VW, I talked to these companies. They do know how to make EVs as well.
Right.
They're putting 100 billion or so behind it, and their investors are very keen on them, and so on. And as I say, I'm not saying that they're going to beat Tesla. I mean, they're obviously they admire what he's done.
Hmm.
But if you admire what he's done, that makes it much easier to copy it.
No, I understand. So Paul, I'd be curious about that. I'm not an expert in Tesla, but one of the things that I wonder about is there another way to monetize his business that could be exponential, that goes beyond the selling of cars in Tesla specifically?
Well, you see, this leads us a bit into a discussion about what is the future of the automotive industry.
Hmm.
And we have very, very clear views on that, as you know, Terry, which is that captured really in the phrase, the next car you buy will probably be an EV, an electric vehicle, and after that, you probably won't buy another car. And what we mean by that is that we're moving from 2024, 2025, we're moving into the world of autonomous vehicles. And so
Hmm.
instead of spending 30, 35,000, even today, 40,000 bucks on a car or a pickup truck that you buy and then you fund in some way and you drive for perhaps an hour a day, which is the average in the States and most countries, half of that time in traffic jams and so on. Instead, you'll have something like a smartphone package. Does anybody really own their smartphone these days? Some people do, but not many, because what you have is a bundle, and with your bundle, you can have a certain number of calls, you can have a certain number of
Hmm.
texts, you can have certain roaming rights, you can have it around Chicago or Detroit, or you can have it cover the whole of the state of Michigan or whatever, or international, etc., etc. And if you talk to the big manufacturers, what they're all saying is don't focus on EVs because the future of the auto market is to become a software-based supplier of mobility solutions. In other words, if you think about the car industry that we've grown up with, it's been about technology. It's been about a Ford engine or a GM engine or a Chrysler engine. And so you've naturally had an oligopoly of 10 or 12 large companies around the world. But making an electric vehicle, by comparison, is pretty simple. Uh, there's some exciting stuff going on about batteries at the moment, but we don't see batteries taking the place. You're not going to have a proprietary Musk battery that is so much better than
Hmm.
GM's or whatever. We think it's much more likely, and big companies like BP have already started to invest in this, in battery swapping. But you're going to have commoditized things. You've got an infrastructure. People get worried about charging, they get worried about range, and so on. Well, look, we've got an infrastructure already on the freeways and and so on of service stations. We're used to driving up, having a cup of coffee, whatever it is we want to do, spending a certain amount of money and going off after 5 or 10 minutes. You can easily adapt that to to battery swapping. Companies like Ample and so on are already doing this on the West Coast and so on. And in China, of course, they're leading. They claim to be able to swap the battery over in a minute, so even faster than filling the tank. So the question then is, if that's the way that the car industry goes, you and I, Terry, can identify a market of 20 or 30 cars, 30,000 cars, and we can happily make a car to suit that market. So what's the role of GM and so on? The answer is the software-based supplier of mobility solutions. VW, would you believe, now employs more software engineers than SAP, the leading supply chain company. So there's a really big shift taking place here. So in answer to your question, I don't think that we're going to see a market where Elon can dominate, because there are people. He might have done, except for two things. One was that in China they were very worried about pollution. You may remember 5 years ago they got their 2.5 level down to about 200 or something in Beijing. The World Health Organization number is around 25. So how do they get further down? Well, they've closed all the coal-fired power stations and so on in Beijing. What do we do? Well, Mr. General Secretary, Mr. President, you have to reduce car emissions because that's what's causing it. Well, we want people to have more cars because we want growing prosperity. Well, in that case, you're going to have more prosperity. You go back to 400. Well, people don't like that. Also, you better go to electric vehicles. Okay, fine. I'll go to electric vehicles. In Europe, you had the great Dieselgate the scandal, where the major companies made a lot of money, on this, but they turned out they fixed the thing. So they were reporting lies, and they've all got fined billions. And in Europe, they were actually caught both ways because they'd signed up to emission levels from 2020 from last year based on diesel, because diesel was 50-odd% of the market, and diesel has very low CO2 emissions. So I think we can sign up to that. We've fooled the regulators. Well, what's it going to be like with gasoline? Oh dear, no problem. And so they had a simple decision that said, do we give away EVs in order to reduce our fines, because the fines are going to run into billions, or do we just pay the fines? I mean, most people can work out it's better to build a market for the future than just hand over dead money. So, I think that those two things meant that Elon couldn't achieve dominance structurally in the market. He can achieve a reasonable position. He can he can be profitable. There's no problem about it. But the people who think he's going to get 100% of everything just haven't looked at it more deeply.
No, that's foolish, Panglossian. I listened to Kathy Wood's market updates. She seems to be a good cheerleader, but she doesn't really seem to understand it as well. And she has to be kind of fed the data from other people who are doing more of the research. And that's probably pretty typical for a role like she's playing now, which seems to be more executive and less on the deep entrenched in the research. So I can to some degree understand that. I guess that this leads me. I mean, these are such big thoughts, Paul, that it's hard to kind of grasp where we're going with all this. But one of the things that you mentioned earlier is politics, and I look at this, and there's some things that seem kind of obvious to me. But I don't know any policymakers. I'm not tied into people that are making the strategic decisions. I've never had conversations. This is just somebody kind of sitting back from afar, looking at this, going, this seems to lead to that, to this, and so forth. And so I've read recently how and this isn't new, but it's sort of now hitting the mainstream a little bit. What this idea that we've got the petrodollar, how we traded dollars for gold to now it's dollars for oil, and that China and Russia are essentially taking oil in local currencies as opposed to US dollar currencies. They stopped buying US treasuries, right? So it's left the United States in the position to now have to finance our own debt, right? And so the first question, and this is just sort of a yes or no, is, are we in a new Cold War?
We are probably at the start of a Cold War.
Okay.
You're talking to someone who, in his first term at secondary school, for 10 days, was kissed by his parents every morning as he went off to school, who said to him, "And we hope we see you tonight."
That's a scary proposition for a parent.
That was, of course, the Cuban Missile Crisis. And of course, I was brought up in London, and London had been bombed, so there was no question of people panicking. My parents had all grown up in London; they'd gone to work with bombs falling around them, because that if you didn't do that, Hitler would win. So there was so that was quite clear. When we had a reunion of our year, and before we went back into school, we sat in the pub, and the first thing that everybody said was, "Do you remember that?" That was our first month, and so on. And and we're not there, and I don't think that China wants to have a war. So I think that's important.
Well, let me be a little more clear on that, because I didn't mean like a Cold War that would lead to a kinetic war, but rather It seems to me that we've been going on an information slash financial war that's been taking place. Because one of the things that I've read, I have no way of validating this because again, I don't know the right people. But it does seem that by kind of rerouting, working on trying to remove the US dollar as the world's reserve currency, by China and Russia going in and doing deals that are outside dollars, not buying treasuries. It seems to me that the United States, from a national security standpoint, our biggest challenge is our debt, right? It can be used against us.
Yeah, yeah.
And it's not, this isn't a quick death, right? For the US economy. It's more of a slow moving, but there are things that can be done and orchestrated to make it a lot more difficult on the United States. And some of this is just human nature, right? What ends up happening is when you're the world's economic superpower, you get fat and lazy, right? And you produce kids that don't know what it's like to work. Like, my grandpa, he stormed Normandy Beach, right? Imagine that 19-year-old experience versus my 19-year-old whose biggest challenge is the frickin' Starbucks doesn't have a drive-through today. So she has to actually go in and pick her coffee, right? I mean, these are two radically different worldviews, and you can understand how the United States has gotten relatively soft in terms, in some ways. I'm not saying that we're soft in other ways, but the point I guess I'm trying to make is that debt can be wielded as a weapon, and if you start trying to kind of subvert the US dollar and go to other things, and look, in the end, maybe it's better for humanity if that's the case anyway. So I'm not saying that these are all bad challenges, but what I do think is happening, and maybe you can tell me whether you agree with this or not, but it does look like globalization to some degree has been stopped in its tracks. Populism has arisen for different reasons, and it looks to me like the United States, just in a self-interested perspective, is probably better off deglobalizing, bringing manufacturing back onshore, tightening up our own fiscal house, and being less of a world's policeman. Right. And look, whether you liked Trump or not, those were things that were good for the United States. And now we're sort of reversing some of that stuff and going back, at least in the short term, to try to anyway. But when you look at what's happening now, it's like, well, he was probably right. And regardless of what some of the political people want, in the end, we're going to have to do this because it's our own solvency and our own economic sort of best interest to make some of these changes. Do you see it that way?
Well, I find it hard to think that Trump was a good ambassador for the
terrible ambassador.
I mean, he was. If you're trying to get new ideas across, he's the last person you'd want to do it.
100% agree with you. He's, and this isn't a statement about Trump as a politician or an ambassador, but really just on a fundamental principle that he understood, I think, economically the challenges that we faced. And so if you forget what he says and look at what he did, the policies in terms of bringing manufacturing back to the United States, decentralizing Washington to some degree, getting away from 9 million people that are employed either directly or indirectly by the US government, and sort of shrinking that and adding power back to the states and giving more localized control over the economy. To me, that made sense. And
I was in Houston during Reagan. And contrast and compare. Reagan was trying to do some equally difficult things, and he clearly had opposition, and he was clearly prepared to take on the opposition. Let's face it, he got shot. So the fact that he carried on after that, and of course one of his security details died in that, won him a lot of respect compared to a president who had ducked military service. He was the real thing, and people took him seriously in what he was saying. And I think the problem with Trump was that you didn't take him seriously in that. You felt it was reality TV and focus groups.
He was a bit of a cartoon character as a personality.
Yeah, exactly. Whereas people said at the time, it's interesting. Say contrast and compare. People used to say, Reagan's a B picture actor. Yeah, he was a B picture actor, but actually he ran the equity union. He was used to some pretty hard men in Hollywood that he negotiated with. So
He
when
was
he
a bit of an erudite, wasn't he?
like,
I mean,
sorry?
it was easy. He was a bit of an erudite. He was easy to underestimate because of his
Oh
aw
yeah,
shucks personality. But
yeah.
behind the scenes, he was probably smarter than most of them.
Oh, yeah, and he had that great thing of a leader, which is to only focus on two or three big things.
Hmm.
And and he went to bed at 9 o'clock. You know, I'm not staying up here all night worrying about this. But he dealt with the studios, so he had a background when he came up against the Russians. He knew how to deal with them.
It's a
And
pretty
that.
fascinating, study in
Mm,
psychology and the ability to negotiate. One of my favorite quotes around negotiating is whoever cares the least is likely to win,
mm.
right? And it's a
Oh
strange
yeah,
dichotomy because you have to be willing to give away the thing that you're negotiating to get, and it's a hard thing to do when it becomes really important,
yeah.
right? So it's a fascinating psychology piece. So I could take up all of your time, and so I just kind of I
Well,
really
let's just come back to that question that you asked about China and Russia pinching, well,
yes.
China pinching stuff. This is only what the United States did with the United Kingdom. This is unfortunately is what happens. That a rising power
Hmm.
hasn't got the capacity to develop everything itself, so it pinches it from the power that's there. And so as a Brit, I understand your complaints about China, and I say, excuse me, can I just take you through this? And would you like to pay reparations for all this stuff? you know,
Well,
that is what happened. Secondly, why did we get to the debt? Because this goes right back to the Greenspan argument. Greenspan deliberately decided to expand the subprime market for housing in 2004 and
mhm.
2005, and so China went into vendor finance. In other words, you haven't got enough money to buy it, but I'll lend you, the money that you pay me for it, I'll lend back so you can buy some more,
Mhm.
right? And you would have thought after 2008 that the geniuses at the Fed would have realized this wasn't a very good thing, but they didn't. They doubled up and then they trebled up, and every time the market began to go down, they did QE3, QE4, twist, God knows what it was. And so that's a self inflicted wound that the
Mhm.
States has done because it took the wrong policy. And it's been doing it wrongly now for 20 years, so it's going to take 20 years to unwind it.
So I
And
guess
there's
on that
very
note,
painful moments.
I mean, I can't argue that logic, Paul. I think it makes perfect sense to me. And I guess what the way that we see this is there really only one way to unwind this? And that is to just inflate, deflate the currency, inflate certain asset prices, try to survive that process and end up with a better balance sheet in some period of time. Is that the only way out?
Well, I think what you have to do is you have to look at China, because China is trying, China's got a much bigger debt problem
Hmm.
and a real estate problem than anybody else has. Because after 2008, it thought it was going to lose all its exports to the States and to Europe. And so they had 24 million people unemployed in February 2009. So it did stimulus on steroids,
Hmm.
really. I mean, the subprime on steroids. And it continued like that. And Xi Jinping, in his second term, 2016, 2017, started to try and unwind that because he saw that was a bubble that would burst. But then Trump came along with his trade wars, and you learn from the study of history and Napoleon, and the Second World War, you don't fight on two fronts at once.
Right.
So if you're going to take on the world's leading power, you better have it fairly quiet at home. So he went another 4 years. But if you look at that recent meeting with Biden and Xi, what you see is that Xi was desperate to avoid any kind of confrontation because he is trying to unwind this bubble. And
Mm.
it's people, I think, have got the wrong end of the stick on the bubble. If they've heard of Evergrande as the largest developer, $300 billion of debt, that sounds pretty bad. Oh, is that Lehman Brothers? No, that's not Lehman Brothers, because the Communist Party, and it's a Communist Party, the answer is on the tin, if you like, in the name, is not going to let 1 million people who've bought a house or an apartment with Evergrande not get their apartment. That way lies social unrest and potential end of the Communist Party rule. So they will manage that so that local governments and better financed developers take up those unfinished apartments and make sure that they're finished. They also don't want to jeopardize the high yield dollar offshore bond market. It's only $200 billion. I mean, 200 billion, obviously, to you, Terry, is just sort of chicken feed that you give to the kids. But it's quite a bit of money, but it's not that much. And so what they've said to Lee and the CEOs is, look, you've got these billions. You're going to sell your property in Hong Kong, and you're going to start paying that back. And so they don't want a financial crisis for various reasons. But the real impact, which people haven't really cottoned on to, is that real estate is something like 25 to 30%, when you total it all up, of the Chinese economy. And they've been building speculative apartments. So in other words, you build apartments that nobody is ever going to live in, but you can't get your money out of China because of capital controls. You don't put your money in the stock market because you know it's all rigged against you. But housing, there's only been a housing market for 20 years, housing always goes up. And you say to yourself, the government will never let prices fall. Well, we've heard that before.
Right.
And for the Chinese, they've never dreamt with it. So you've got to try and unwind that bubble. And the way you unwind it is you reduce the amount of speculative building. So GDP goes down. You can argue about how slowly and so on and so forth. But let's assume for the moment that China can manage that reasonably one way or another. But what the world economy can't manage is the fact that China has been more than a quarter of global growth since the financial crisis. And that global growth, when you go into it, has been largely based on speculative real estate buildings. I'll give you an example of what I mean. I have a friend, senior guy in the chemical industry, who sells insulation. Those white plastic blocks that you see when people are building. And he saw that they were building in places like Sichuan, where the temperature goes down to -20. So he said to his sales team, we'll go there and we'll get some orders. And he went to see the developers, and they said, we don't need this. So what do you mean?
Nobody's going to ever live there.
Nobody's ever going to live there.
Yep.
And
Unbelievable.
The great thing about Feng Shui, which couldn't happen anywhere else, is that under Feng Shui, a property that isn't lived in is worth more than one that is.
Well, okay, we know that's not. We can see the writing on the wall. How that's
so what I'm saying is that China will manage that downturn, but how will we manage in the West the loss of all that demand?
Is there more?
We can't replace it.
Is there more? I mean, that in and of itself, to me, Paul, is a scary thought, right? But if you take it another step further, is there counterparty risk outside of China beyond just the drop in GDP and the drop in consumption, where people's sales are going to go down? But is there counterparty risk in terms of people that just aren't going to get paid on assets that they invested in that were in China but are not? So obviously China's going to take care of itself, right? And I read this, so I read this in your piece, and I'm kind of feeding you what you already know. I'm just looking for a little more insight on it. What is the counterparty risk, right? So who's not going to get paid that was expecting to get paid outside the borders of China?
Well, the people who are not going to get paid are the people who built what are going to become stranded assets. So let's look, for example, at the chemical industry, which spent $200 billion on building new assets down mainly in the US Gulf, based on supposedly cheap shale gas, which was basically going to go to China. And the idea was China would always grow at double-digit rates, and it would always be a major importer. So things like polyethylene would always go. Well, sorry guys, actually China's pretty well self-sufficient now. I mean, Trump's trade war meant that they accelerated their own plans for new capacity, and their own demand is going down. So what are you going to do with it? And similarly, of course, if you look at the oil industry more generally, and I'm personally sad about this, because after all, I did live and had a very happy time in Houston, Texas, which is rather connected to oil and chemicals. So I'm not pleased about this at all. But what you've got now is a world where you're moving very fast towards electric vehicles, which means that if you've put money into oil and gas exploration or into that, you are probably dealing with stranded assets. And so, whether they're stranded assets for chemicals or whether they're stranded assets for oil and gas or whatever, the risk is you've built something for which there is now no demand.
And so that spills over all over. Well, so
Yeah.
if you were to kind of handicap a top three, is it Europe, the United States, and who else, or is it just Europe and the United States that are the largest counterparty risks outside of China related to what you've just described?
I mean, everybody's a counterparty risk. I mean, Japan is a counterparty risk. The only people who are not counterparty risks are the people like India who are not really integrated into the world economy.
Yeah.
You know?
So that's a scary proposition because there's a day of reckoning coming,
Yeah.
or a not a day, but a period, right? A period of reckoning that we're going to see.
The only thing is that I'm actually very positive because I do believe that these things are wrong and they will need to be sorted out. And if you've made wrong decisions, you do get painful repercussions.
Mm-hmm.
There's no point in being a snowflake about this. It happens. You made the wrong decision. That's it. However, what you have got is net zero and climate change. And you've got the chance, which the governments do seem to be taking up one way or another, of resetting for this new world. And so, unlike in the past, where it was an either or, a zero sum game of, well, if you haven't got China, there's nothing you can do, you're into recession or depression. Actually, now it's a net zero game. And what you're looking at is, no, we are going to lose all that, but we have got this opportunity here. And if you go back to Reagan and Thatcher, they went through a similar exercise where they said, look, all the stuff that we've been doing is for the past. It doesn't work anymore. Coal mining and the steel works and all of these things, the dominance of the unions and so on, all this has to change. And it was pretty tough battles that they had to get that through. But it freed up, after a while, money that could be used to invest in the industries of the future dot-coms and so on.
Mm-hmm.
So you have to go through this. If you had perfect vision and you knew exactly what was going to happen in 2030 and 2040, and if you were all surrounded by people who were prepared to do that, then you wouldn't make these mistakes. But we haven't been in a society like that in my lifetime, and I doubt we're looking forward to it soon.
It does not appear that way.
Yeah.
So I guess I'll ask you one last question, and this is a bit selfish, but I'm going to be a little greedy today, I guess. You've been so generous with your time.
That's a really interesting discussion. So thank you, Terry.
Well, and I could sit here and have this discussion all day because I've learned so much already. But one of the things that I'm here to do is I'm here to advocate for my clients. And I work with mass affluent people that are somewhere between the ages of 45 and 75. And this is a brave new world. Most of them don't understand it, don't understand the topics probably that we've talked about today, because let's face it, you can't get what we just did in a 30-second soundbite, right?
Yeah.
On Fox Business or CNBC or anywhere else. So with that all being said, if you're someone that's either heading into retirement or already retired right now, okay, and you need yield because we're at yield curve control, interest rates are low, they're probably never going back up any at the short end of the curve, anything substantial, it doesn't appear that way. How are we going to manage this from an investment standpoint? So what would you be doing if you were Terry Sawchuk, and I think you're glad that you're not, but if you were Terry Sawchuk and you had to advise your clients on how to invest their money, knowing what you know now and trying to get through the next 3 to 5 years, what would that look like?
A very simple answer, I think, Terry, which is, I started my investing life in 1982, and I knew nothing about it whatsoever. And I went to an advisor who looked after me very, very well indeed. And as I began to explore what this was all about and try and understand a bit more, I realized that there were, popular things that you could read about, and you could read, USA Today, or you could read, Wall Street Journal or whatever, and they'd give you the flavor of the month, and it would all be this and so on. And I kind of noticed that, they would tell you one thing one month, and then a month later, they'd be saying completely the opposite. As if they never, never remembered that. Wait a minute, you wrote this, sort of thing. And so I looked a bit more, and I came across people like Ben Graham, who was the person that Warren Buffett acknowledges as his guiding star. And, Warren persuaded Ben to take him on. And Ben came up with some very simple rules for investment. Ben was investing in the 1930s. Not exactly an easy time to be doing it, And so what he did was to, one of his simple rules was about fair valuation. And he said, if you have a PE ratio of 8.5, then that tells you that the market overall is expecting the stock to do nothing upwards or downwards in terms of earnings over the next 10 years. And every 1% of growth that the market is expecting, you can add 2 points to the PE. So if you think, Amazon is going to grow at 1% a year for the next 10 years, then it can have a valuation, a PE of 10.5. Now, remarkably, after the crash of 87, you follow me through, I'm busy learning all this, I'm thinking about this and so on. There were lots of worries. Why did the market go down 25% overnight? And a year or so later, the Harvard Business Review published a research paper from somebody who said, we're an economics department, we were pretty worried about this. We came up with this formula, that sort of stuff. And then he said, one of my students tried the old Ben Graham formula. And he said, on the Monday night of Black Monday, virtually all the stocks in the Dow 30 and the Dow 30 itself went down to the value predicted by this Graham formula. So in the clearest, possible moment where nothing else mattered, just the market just did its thing over a 24-hour period or an 8-hour period, that was what happened. And I thought, well, that probably makes sense. And so I stuck to that kind of rule. So if you look at your investments, what you say is, well, how do I think they're going to do over the next 5 to 10 years? And if you say, well, I can't do that, I can only tell you about the next 5 minutes, you say, well, you're probably in the wrong investments then. Because I doubt that P&G and so on are going to disappear. They've stood quite a long time. The question is, are they fairly valued by the market today, or are they overvalued? And you just have to hunt through. And that's where someone like yourself, Terry, might just be able to add a bit of value.
Well, fortunately for myself and my clients, I actually have some people that are a whole lot smarter than I am that are looking after those decisions.
Yeah.
But I certainly appreciate where you're coming from on that, right? Because in the end, you're buying value and you're not overpaying for quality companies that are not going to be here just for the next 3 years, but are going to be here for the next 30 and 40 and 50. I suppose that comes down to leadership, right? Having the right type of leadership that can guide them. Because let's face it, if Raoul Paul is right, and he says pretty regularly that we're going to see more change in the next 5 to 10 years than we have cumulatively in all of human history, you're going to need leadership to guide you through that change, right? Yeah. And so that's a testament to, I think, finding people who are good leaders.
Yeah, exactly. And one has to remember, as Ben Graham also pointed out, that in a year, the average stock will go up 50% and fall 30%. If you bail out when it's gone down 30%, you miss the opportunity for it to go back up 50%.
It's an 80% swing, right?
Yeah.
When you think about it.
Yeah, there's nothing unusual about that.
No, and that's maybe that's really more a testament to human behavior, right? The greatest role I think we play as advisors, ones that are good at what they do, are helping clients manage expectations and manage behavior so that they don't follow their instincts, which is to do exactly the wrong thing at the wrong time.
Yes, that's right.
So, well, Paul, I can't thank you enough for the time that you've generously shared with us, and not just the time, actually, that's the smaller part. The greater part is the wisdom and the knowledge that you've shared with us. That's even more valuable than the time. And so I thank you very deeply for your efforts today. And on a side note, if there's anything that I can do to help you in any way, I would certainly love and welcome that opportunity. And if you're open to it, I would love to have this conversation again in the not too distant future, and just kind of pick up and see
Yeah,
see what we've talked about and how things have played out relative to our chat.
that would be delightful.